Hello, everyone. This is Clinton. That's Kevin. We're coming back with another Financial 15. We attempted to do a live event this morning. A little bit of a technical error, but I think we figured it out. So we're going to record this one, version 2 of how I invest my money. We're going to talk about our personal finances, provide some transparency. Hopefully we can learn a few lessons, help you improve your financial knowledge. Before we dive into it here, a reminder, please hit the like button, subscribe to the YouTube channel. That way you won't miss any of our content and you'll be kept in the loop. So let's start this off. Version 2 of how I invest my own money, Kevin. Let's start with the personal finances. Top of the list here for the questions. The debt, the mortgage. What was your first mortgage like?
Yes. We're going to practice what we preach here. Debt, when my first mortgage came out, it was all about making sure that you paid off your debt as fast as you could. Part of the reason was interest rates were substantially higher than they were now, sort of that 5 to 8% range. So you're not getting that much on your investment. You got to pay down your debt as fast as you can. So, I mean, that was a key for us going forward here. Any other new accumulated debt hasn't been quite the same scenario, with the exception of credit cards. Credit cards at a high debt, I tend to pay those off as fast as I can. But lines of credit and things like that all come down recently. So my version's changed a little bit over the last 20 plus years that have been around for it. How about yourself? What kind of mortgage debt are we looking at?
Yeah, I'm not in a rush to pay down my mortgage. My wife, Jody, and I, of course, to get rid of any high interest debt right away. We don't want to have credit cards because they're 15, 20%. They're very high rates. But for our mortgage, we're at 2.5. I'm in no rush to pay that off. We can get better returns on our investments. So I think it's a better use of the capital. So we don't like to have a lot of debt, but with a low interest rate environment, having a little bit of a mortgage, in my opinion, not a bad thing. We're not in a rush to get rid of that house. So move from debt, another area of the personal finance, the emergency fund. Often when we meet with clients, we say 3 months, 6 months of expenses. You want to have that fund built up. But there's a few variables involved, right?
Definitely. And anytime you take a look at your emergency fund, I think you have to look at the type of job that a person has or doesn't have, as it were. I mean, in a situation where employment can be seasonal, or if you work on a commission basis or things along those lines, you may want more. You may want that 8 to 10 month sort of scenario because things are unsure. And that way you at least can cover the debt that you have or the payments that you have to do, the normal expenses that go on. So yeah, I would say on average, it's a 3 to 6 month time frame we want, but it can be longer depending on your job and also where you put that money for an emergency. Sure. Some do a TFSA. Myself, my TFSA is for my investments, so I hold it in a separate place as well. What's your emergency situation like, Clint?
Yeah, I'm the same for you. I don't like using my TFSA for emergency funds. I prefer to invest that money, try to get more growth out of that tax-free room. For my emergency fund, though, it is certainly in the 10 to 12 month range, not the 3 to 6, for the reasons you just mentioned, right? Our job, we don't have a defined salary, so there's a little more volatility there. And plus, my net worth is in the market for the most part, plus my income's tied to the market. So I got a lot in that area. Personally, I feel a little better having a larger cushion than average. So not saying everyone needs 10 to 12, 3 to 6 is normally a good range, but for the variables you mentioned, I prefer to be on the high side for that, for the emergency fund. Moving to the investment worlds, everyone's a little different when it comes to their investments. I'll lead off here on that category. I like to use the pension approach, the same category, the same approach we use for our clientele. What that means is not too many mutual funds, shying away from that, more individual stocks to make up that core, a few ETFs. We have a tactical component that is a little more active. And then we like to have that nice, stable private debt, private equity. Most of our clients would have a mix exactly like that. And I'd be right alongside with them with very same investments. The slight difference, that would be 90-95% of my money. You might have a little sliver off to the side. I think we called it a Vegas fund last time we did this. Something yes, a little more speculative. For me, it's scratching that itch. It allows me to be analytical, allows me to take a few speculative bets and leave the rest alone, just that little bit to have a little more fun. What about you?
Yeah, I agree. I mean, basically being in the business for as long as I have right now, I started off when, buying stocks, buying mutual funds. These were the big things. You could buy your own preferred share. You bought your own bonds. You didn't worry about a lot of the ETFs. They weren't really that big a deal at the time. So I have a variety of different mutual funds and stocks and preferreds and bonds in my portfolio. And I've built a lot of clientele portfolio the same way. Now that I am a portfolio manager, I am starting to move around that same sort of scenario. I want to have more private equity. I want to have a little more private debt, offer some stability and another arrow in the quiver, as it were, for that sort of a thing. And yes, the Vegas fund is definitely there. Seeing as how I can't go now, I got to bet black and red another way. So, but again, it's not for everybody. And it's just something that's extra for us. But, if you do have that option, it's always something to take a look at. Are there other points on what you do investment-wise, Clint?
Yeah, a couple of them. One, the hand gesture there was appropriate. It's a very small piece that makes up that Vegas fund. You don't want it to be half your portfolio. That'd be way too risky. That's right, tiny amount. And then the second is I like to automate. I believe in having things simple. Take your own behavior out of it. Just make it automatic. So when I was 18, I got in the habit of setting up a monthly contribution. I was paid monthly at the time, so it made sense. It matched my paycheck. Money was just being put aside into the investments every single month, and I've never stopped that habit. Once you build a habit, it's easy to continue it, and that's the idea. If you get into that automated approach, it just builds faster than you think.
I keep explaining that to my kids the same way. Put money away now, that way you don't have to worry about it as much later. I mean, they're a big expense as it is, so I'd rather than do that now, and I don't have to worry about it. Sorry, I didn't mean to cut you off there.
You just refer to them as a big expense, but parenting, I get it. A lot of money out the door to help kids. It's a lay of the land, right?
Yep.
All right, we'll move on. Talking behavior, because automating it takes our behavior out of the equation. And I wanted to bring this up. It's from Morgan Housel. He does a lot of great writing. He's a partner with a collaborative fund. This particular piece is a blog post that came out in December 2020. I'll read a quick excerpt here. It says, it's easy to ignore the power of tail events because it's painful to accept that most of what happens isn't that important. He has an example over the last 20 years, 9/11, Lehman Brothers collapse, COVID-19 were pretty much the only economic headlines that moved the needle. He goes on to reference into investments, into behavior, and says how you behaved in March of 2020 was probably more important than what you did in the previous 100 months combined. Behavior matters. Behavior in uncertain events matters a lot more. So with that intro out of the way, March of 2020, buy, hold, sell. What did you do, Kevin?
Well, basically for a lot of it, I was on the hold side. I mean, for me, money is a long-term time frame. Most people that are investing, I mean, if it's retirement, you're not doing it for a year. You're not doing it for a month or 6 months. You want to hold. Now, again, it's the same sort of thing. When the market was falling in March, I suggested people hold. As soon as we started to see that things started to recover, then you know what? There's a little picking away here and there. Maybe there's buying a little tech, which we did, and a few other odds and ends. But that's sort of the scenario. It's not, you want to tweak the portfolios when you have the chances, if you got the dips that are going on. But again, it's a longer term time frame. So I think that's exactly where it should be. Where were you in 2020?
Same idea. In March, generally, it was a hold during the really volatile days, because we had a couple days that were a drop 5 or sometimes 10% in one day. During those days, I was hitting the buy button. Now, my situation's a little different. I got a long time frame. If it took 10 years to recover, I was okay with that. Now, it ended up being a very fast recovery to our surprise, but I was comfortable buying during those volatile times because of the long time horizon. So I was a hold with a little bit of nibbling, a little bit of buying. If you rewind back to that 08-09 situation, now that was a longer drawn out crisis. It wasn't just a quick down and up like we had in 2020. And even during then, I did a little bit of buying as well. What about yourself during the great financial crisis?
Yeah, you mentioned that. And I'll go back all the way to the tech wreck where it happened back in 2000, if I want to start there. And there's a variety of different options that were going at that point in time. But you're right. I mean, when you start mentioning the events, those are the only three people remember. They seem to forget that there was a debt crisis going on in Greece back in 2012. You had the Chinese debt crisis. You had oil problems that were going on in 2015. Nobody remembers this, but they do remember the big ones. Yeah, I mean, the TSX was roughly 11,000 points then. It's about 18,000 now. So it's continued to move. And as we've seen, time heals all wounds, as it were. But buy on the dips, and that's sort of the same scenario. When I hit 2008, it was the same thing. Longer term time frame, long run. Always maintain caution, but make sure you're emphasizing what the final goal is.
Mm-hmm. Yeah, that's very true. Very true. So both of us were more or less hold during the big crisis. There was a little bit of buying. The key here, for our core of our portfolio, we weren't selling. We weren't trying to hit the sell button, so we got to move to cash and then trying to time to get everything back in, because that is a very difficult equation to figure out, especially if you're doing it with the core of your portfolio. So that was not what we've been suggesting, and that's not what we've done. How we managed our money during the crisis was primarily hold with a little bit of buying. Any last comments you want to make there, Kevin? Any parting words for folks?
Yeah, basically, I mean, if there's any questions or anything else you have, by all means, please feel free to get in touch with us, chat with clintonandkevin.com, or consult the website at Becker. We are more than happy to help out with anything we can. We've got a variety of videos on there right now, so hopefully they are very informative to you. And if there's any topics you want to see, hey, let us know. We're more than happy to talk about most things out there, as you've seen on our back and forth videos. Other than that, I think that wraps up everything I need. How about you?
That covers it. That covers it. We appreciate you sticking around for version 2 of how I invest my own money. We figured out the tech this time through. We'll be back again with another video next week. Until then, everyone stay safe and take care.